The Consistent Investor: How to Build Wealth with Discipline and Patience by Booksmart Club. Introduction: The Quiet Path to Wealth. Most people believe investing is a game won by the smartest, the fastest, or those with insider knowledge. They imagine millionaires as Wall Street wolves, glued to Bloomberg terminals, making lightning-fast trades. This image is a myth, one that keeps ordinary people from ever getting started. The truth? Real wealth is built in silence. It comes from the boring, unsexy habits that nobody talks about. Automatic transfers you set up once and forget. Sitting patiently through market crashes without flinching. Ignoring the 24/7 financial media circus. This book is not about getting rich quick. It's about getting rich, I'm sure. Through a system so simple it feels underwhelming at first glance. But make no mistake, this is how the real millionaires are made. Why discipline beats intelligence. Warren Buffett, one of the richest investors in history, credits his success to two things. 1. The power of compounding. 2. Sitting on your ass. That's it. No day trading, no complex derivatives, just buying great assets and holding them forever. Yet most people fail at investing not because they lack intelligence, but because they lack the ability to do nothing. The investor's paradox. The more you watch your portfolio, the worse your returns become. Studies show that investors who check their portfolios daily earn 4% less annually than those who check quarterly. Dalbar. The best performing accounts are often owned by people who forgot they had them. Fidelity Research. This book will teach you how to engineer your environment so that discipline becomes automatic. You'll learn how to set up a portfolio that runs itself. Why financial news is designed to make you poor and how to ignore it. The psychological tricks to stay calm during market crashes. This is not a book about stock picks. It's a book about behavioral mastery. Chapter 1. The Power of Habits in Wealth Building. Most people believe investing is about picking the right stocks at the right time. They imagine financial freedom comes from brilliant market predictions or secret strategies. But the truth is far simpler. Wealth is built through consistent habits, not genius. Consider two investors. Investor A spends hours each day watching financial news, analyzing charts, and making frequent trades. He believes he can outsmart the market. Investor B sets up automatic monthly investments in a low-cost index fund and rarely checks his portfolio. After 20 years, who do you think comes out ahead? Studies show Investor B almost always wins. Not because he's smarter, but because he's more disciplined. The 3 wealth-building habits you need. 1. Automate everything. Set up recurring transfers from your paycheck to your investment account. Treat investing like a bill, non-negotiable. Example: $200 per month automatically into an S&P 500 index fund. 2. Ignore the noise. Financial media profits from your fear and greed. Stop checking stock prices daily. Quarterly reviews are enough. 3. Think in decades, not days. The market goes up and down, but over 20-plus years, it trends upward. Example: if you invested $10,000 in the S&P 500 in 2000 and held through crashes, you'd have $35,000+ today. The janitor who died with $8 million. Ronald Reed, a gas station attendant and janitor, quietly amassed an $8 million fortune by investing consistently in blue-chip stocks like Coca-Cola, Johnson & Johnson. Never selling, even during market crashes. Living frugally and letting compounding work. His secret? Discipline, not stock-picking genius. Action plan. Build your investing habit. Today. 1. Open a brokerage account. Fidelity, Vanguard, or Schwab. 2. Set up automatic investments. Start with whatever you can. $50 a month is enough. 3. Write down your rules. I will not sell unless I absolutely need the money. Asterisk. Chapter 2. Dollar cost averaging, the investor's secret weapon. What if I told you there's a strategy that removes emotion from investing, lowers your average purchase price over time, works whether the market is up or down? It's called dollar cost averaging, DCA. And it's the simplest way to build wealth. How DCA works. Instead of trying to time the market, you invest a fixed amount on a schedule, e.g. $500 every month. When prices are high, your $500 buys fewer shares. When prices are low, your $500 buys more shares. Over time, you get a lower average cost than if you tried to guess the right time to invest. Real-world example. If you invested $1,000 per month in the S&P 500 from 2000 to 2020, including the 2008 crash, your average cost would be far lower than if you tried to time your entries. Why 99% of investors should use DCA. 1. No market timing needed. Even professionals can't consistently predict highs and lows. DCA ensures you buy at both highs and lows, smoothing out risk. 2. Psychological safety. Net. If the market crashes, you're not panicking. You're excited to buy more at a discount. 3. Perfect for beginners. You don't need a lump sum to start. Just invest what you can, when you can. How to set up DCA. 1. Choose an index fund, e.g. VOO/VTI. 2. Set up automatic investments, weekly, bi-weekly, or monthly. 3. Never stop, even during crashes. Pro tip. Increase contributions by 1% every year. Small boosts compound dramatically over time. Chapter 3. Start small, think big. You don't need thousands of dollars to start investing. You just need to start. The power of tiny investments. Investing $5 per day equals $150 per month equals $1.1 million in 40 years at 8% returns. The key is starting early and staying consistent. Case study. The Barista Millionaire. Sarah, a Starbucks barista, started investing $100 per month at age 25. By 65, she had $1.2 million, walkwise, without ever making a six-figure salary. 3 simple ways to start today. 1. Micro investing apps, Acorns, Robinhood. Round up spare change from purchases. Example, spend $3.50 on coffee. 50 cents gets invested. 2. Employer 401k match. If your job offers a match, contribute enough to get the full match. It's free money. 3. Low-cost index funds. Buy ETFs like VTI, Total Stock Market, or VOO, S&P 500. No need to pick individual stocks. But what if I lose money? Short-term dips are normal. Historically, the market always recovers. The only way to lose is to sell in a panic. Your first step. Open an account today and invest. Something. Even if it's just $10. Chapter 4. The Psychology of Discipline. Investing isn't about intelligence, it's about controlling your emotions. Why smart people make dumb money moves. 1. Fear. Selling in crashes. Example, people who sold during 2008 missed the recovery. 2. Greed. Chasing hot stocks. Example, investors who bought Bitcoin at its peak lost 70% plus. 3. Overconfidence. After a few wins, people think they're invincible, then take reckless risks. How to stay disciplined. Write down your rules. E.g., I will not sell unless I need the money for an emergency. Avoid financial news. It's designed to trigger emotional reactions. Focus on the long term. Remind yourself, I'm investing for 2030, not tomorrow. Chapter 5. The 10-Year Rule. If you aren't willing to own a stock for 10 years, don't own it for 10 minutes. Warren Buffett. Why time is your greatest ally. The S&P 500 has never lost money over a 20-year period. Even if you bought at the worst possible times, like before the 2008 crash, you'd still be up today. Action step. Before buying any investment, ask, will I still hold this in 10 years? If not, skip it. Chapter 6. Automate your way to wealth. The less you touch your investments, the more they grow. How to set up a no-touch portfolio. 1. Automatic transfers. Schedule deposits on payday. 2. Robo-advisors. Betterment. Wealthfront handle everything. 3. Forget about it. Seriously, check once per quarter at most. Chapter 7. The magic of compound interest. Compound interest is the eighth wonder of the world. Albert Einstein. How small investments become millions. $300 per month at 8% for 40 years equals $1.2 million. The key is starting early and never stopping. Chapter 8. Rebalancing without sabotaging yourself. Once per year, adjust your portfolio back to your target mix, e.g. 80% stocks, 20% bonds. Why? It forces you to sell high and buy low without emotions. Chapter 9. The 5 Deadly Sins of Investing. 1. Panic selling. 2. Chasing trends. 3. Overtrading. 4. Ignoring fees. 5. Waiting for the perfect time. Chapter 10. Your Lifetime Investing Plan. Final action steps. 1. Open an account today. 2. Automate your investments. 3. Write your rules and stick to them. Remember, the best investors aren't the smartest, they're the most disciplined. Conclusion. The Millionaire's Checklist. If you take nothing else from this book, remember these 5 rules. Omchiya Sankri. 1. The automation mandate. Your investing system should run like your heartbeat, without conscious thought. Set up automatic transfers the day after payday. Use a robo-advisor or index funds to eliminate decision fatigue. 2. The 10-Year Rule. Before buying any investment, ask, will I still own this in a decade? If the answer is no, skip it. 3. The media blackout. Financial news exists to sell ads, not to make you money. Delete stock apps from your phone. Schedule portfolio reviews quarterly, no more. Svaker Farstawa. 4. The Crash Playbook. Market downturns are where fortunes are made. When others panic, your plan kicks in. Keep buying. Prices are on sale. Never sell unless the investment thesis changes. 5. The Compounding Covenant. Every dollar you invest today is a seed for future freedom. Invest first, spend second. Increase contributions by 1% annually. Final truth. Wealth doesn't come from what you know. It comes from what you can ignore. Master in action, and the market will reward you beyond your wildest dreams. Now go set up your automatic investments and get back to living your life.